Hey guys, welcome to my channel Investing Untangled. Hope you're all doing well. So on this channel, I post content about stock market research and stock analysis. I also break down complex financial concepts into simpler terms, and I show you how to analyze stocks and what kind of companies I'm investing in. And if this is something that sounds interesting to you, please consider subscribing and hit that notification bell to get notified whenever I upload a new video. So in today's video, I'm going to be discussing two companies with you which I think are fairly priced. Actually, one of them I think is undervalued. So in this expensive market, it has become very difficult to find reasonably priced companies for great returns in the future. And I generally look for companies that are away from Wall Street spotlight. That means these companies are still reasonably priced. So let's check out what these companies are and let's go into the analysis now. So the first company I'm going to talk about today is Store Capital Corporation, ticker STOR. So this company, you can see its stock price has steadily grown upwards up until the March lows. So it went all the way up to $40, and then in the March crash it came down to $18, and since then the price has actually gone up and it stands at 32 right now. So it is an $8.5 billion market cap REIT company, which is real estate investment trust. So this company deals with the real estate market. So here's the company profile. So this is one of the largest and the fastest growing net lease REITs in the US. So REITs, I told you, is real estate investment trust. So a net lease REIT is a company which owns real estate and then it leases it out, and its tenants have to actually take care of all the payments. So they have to pay the rent, they have to pay the taxes, they have to pay insurance, utilities and everything. So the company doesn't take care of any expenses once they lease out the property. So that's the net lease model that they operate in. And this company was founded in 2011 by Christopher Volk. He is a very experienced person in this REIT industry, and you can see he has had 30 years of experience. Before this, actually, he founded another company, Spirit Finance Corporation, which also went public. And then in 2011, he started this company, Store. So now we'll look at who their tenants are. And you can see here that they have actually a very diversified rental portfolio. So their tenants are in the service industry or in retail or in manufacturing, and they are very diversified all the way from restaurants to family entertainment to drugstores to light manufacturing, etc. So they operate in different sectors, which is good because if one sector gets hit, they still continue their revenues from this diversified portfolio that they have. Now we'll check their financials and see how the business is doing and how it has done over the last many years. And you can see that this business has actually consistently grown its revenues, its earnings, and its equity. And it has grown its revenues from $41 million to now it stands at $695 million. Earnings have also grown pretty steadily, and they stand at $218 million right now. And it has been a very consistent growth year after year. Book value per share, so equity of the business, has also doubled since 2014. So you can see from $9 to right now it stands at $18, and their cash flows have also been very strong. So operating cash flow and free cash flow have also been very strongly growing. They are both at $421 million right now. So this looks like a very steadily growing business. Looking at profitability, their net margins actually look really great, and this is something that I really like about this company. So now we'll look at how the current economic distress has actually impacted their business. So we'll look at their current financial statements. So starting with the income statement. So looking at their revenues, it doesn't seem like their revenues have actually been impacted. Their revenues have increased from $171 million to $175 million, which is great. And what is actually really nice to see is that their rental revenues have increased a bit. And I would have expected that in this current economic condition, their rental revenues will be going down, but that has not been the case. And this shows that the business is very stable and it is actually growing. So now looking at their net income, you see that their net income has actually taken a big hit. From $111 million, they have been reduced to $54 million at the end of the third quarter of 2020. And this is comparing it with the third quarter of 2019. And I went a little deeper in this to see where they have actually lost money. And it is right here. Every year, it seems that they get some form of income by disposing of, by selling off some of their real estate. And in 2020, they did not do that, or they did it at a very low level. So their net gain on dispositions of real estate have significantly reduced compared to what they got in 2019 at the end of the third quarter. So that has impacted their net income quite a lot. So I wouldn't worry too much about it because because their revenues are still pretty stable and they have actually grown a little bit. So now looking at their balance sheet, their total assets have actually grown in 2020 compared to 2019, and they stand at $8.7 billion right now compared to what they were in 2019 at 8.2, and the contribution of intangible assets is very low, which is good. So this means the majority of these assets are actually tangible, which means it's their real estate property or the cash that they have. Checking their liability, so it doesn't seem like they've taken any kind of massive debt in this economic turmoil, so their total liabilities actually have not changed, and in relation to their total assets, their total liabilities are much lower, which means the company is financially very stable. And what is also very nice to see is that their total stockholders equity, so their equity has actually grown even though the economy is not doing that well this time. Okay, checking their cash flows, and here you can see that their net operating cash flows actually have gone down, which is understandable because they got a pretty big hit on the net income to start with. So I wouldn't worry too much about it because this is in relation to their real estate disposition, which they did not do in 2020 and they lost some money there. But their rental revenues are pretty strong still. And another thing that indicates that the company is financially pretty strong is the dividends amount that they have paid. They have not cut their dividends, which is a great indication that the company is financially very stable. And here you can also see that there is an increase in net cash from $30 million to $50 million, which shows that there is no problem financially for this company. So now looking at valuation to see if this is a good price to buy this company, we'll check what the analysts are thinking. And the analysts at Simply Wall Street are thinking that this company is almost 35% undervalued, and they're estimating its fair price around $50, and it trades at around $32 right now. So as per their estimates, it seems like it's an undervalued play. I also calculated its intrinsic value myself using the discounted cash flow valuation model, and I came up with an intrinsic value of $33, which is very close to what the company is trading at right now. So this valuation suggests that the company is actually at its fair value and it's not undervalued. And given the current economic condition right now, I would rather wait a bit. If the stock price falls under 30 and if it goes anywhere close to mid-20s or so, that's when I'll be very heavily buying it, but otherwise I'll just wait and see what the stock price looks like. So I'll put this company on my watch list for now, and I'm watching it very closely. I've done extensive research on it and it actually looks very nice, just that I'm not very comfortable with the price right now, but I'm following it very closely. And what is also very comforting to see is that Warren Buffett actually loaded up on this company quite a lot, and he bought a lot of shares. So he bought 5.8 million shares of this company in the second quarter of 2020. Okay, next up is NMI Holdings Incorporated, ticker NMIH. So I did a detailed analysis of this company in my previous video, and I'm leaving the link of that video in the description below for you to check out. So this company has grown its stock price pretty steadily, as you can see, and this is because their business has also grown very stably, that I'll show you in a minute. And in the March 2020 lows, the prices fell all the way to $11 from its all-time highs of $33, and since then the company has recovered in stock price and it stands at $24 right now. I did a complete analysis of this company a few days back when the stock price was around $21, $22, and since then it actually has increased a bit already, but you can still see that it is at a discount. It hasn't gone all the way up to its all-time highs. This is a $2 billion market cap company, again a small cap company. So I generally look for companies that are not under the spotlight of Wall Street, meaning they're not getting a lot of attention and they are still cheap to buy into in this expensive market. So this is trading at a PE multiple of 10, which is great and very inexpensive compared to the expensive market that we have right now. So S&P 500 PE is around 35, and here you have a company which is trading at a PE multiple of 10, which is incredible. If you look at some other statistics here, you'll see that its forward PE is 10 and its price to sales is 4 and its price to book is 1.52. So all these parameters show you that it is undervalued. So this company operates in the private mortgage insurance sector. So it basically insures housing loans for banks, and if the borrower defaults, this company, these PMI companies as they're called, they cover up the losses for the lender, meaning for the banks. And why I'm bullish on these private mortgage insurance companies is because of the fact that Federal Reserve has reduced the mortgage rates to an insane low amount right now. And why this is happening is because Federal Reserve and the government wants that people spend more money so the economy recovers. And what this does is that it prompts people to go and raise housing loans and buy real estate. So this environment is really good for private mortgage insurance companies, and they make a lot of revenue because of these economic incentives that are given by the Federal Reserve. So now looking at the company performance, how it has performed over the years, and you can see the revenues have been steadily increasing over the years. And this is data all the way from 2013, 2014, around this time this company went public. And looking at their net income, so this company became profitable in 2016. And since then, you can see that they have significantly grown their income year after year. Now, if we take a look at their assets, their total assets, so their total assets have also grown steadily, which shows that the business is growing. And now looking at profitability at the margins, so if you look at profit margins, you'll see that this company actually has very strong profit margins of around 40%. And looking at some other ratios now, we'll check debt to equity ratio here to assess the debt of this company. And you can see that their debt to equity ratio is much below 0.7, and that's what I like. So this shows that the company has very little debt in relation to its equity, which means that the company is financially very strong. And now we'll take a look at their returns on equity. They don't have a chart for this here, but you can see the returns here, and they're consistently over 15%, and that's what I like. And so these are great returns. That means the management is doing a really good job at earning these really good returns on their equity. And now if we look at what analysts are thinking about the valuation of this company, if you go to valuation here, you'll see that the analysts estimate that the fair value of this company is around $50, and it's trading around $23 right now. So this shows that this company looks very undervalued right now compared to its fair value. And taking a look at its future growth projections, analysts actually estimate that this company will be growing its earnings around 19% a year, which is very good growth. And again, if you look at their past performance, it has grown its earnings at an astronomical rate of 50%, which is very, very good. So this finishes up the analysis for today. And if you're interested in a detailed analysis of NMIH, I've done that video before, and I've left that link in the description below. So please go check it out. I did pick up actually some shares of NMIH when it was trading around $21, and now it has already gone up a bit, but I still think it is significantly undervalued. And in this expensive market, it has actually become very hard to find companies that are reasonably priced. So let me know what moves you are making in the stocks, and let me know in the comments below what you are doing in the stock market right now. If you got value out of this video, please consider leaving a like and subscribe to my channel, Investing Untangled. I'll be posting new videos about stock market research and stock analysis, and also the moves that I'm making currently in the stock market. So please stay tuned to my channel, and I'll see you in my next video.